Hey guys, Akil Stokes here. In today's video, we're diving deep into understanding fractals in trading and how having a clear plan for which time frames to focus on can solve one of the biggest challenges that traders face. I'll show you why giving into FOMO, fear of missing out, will cost you real money, and of course, share some actionable strategies on how to avoid it. Plus, I'll take you on a full technical walkthrough of a trading opportunity from start to finish, looking at price action, structure, Fibonacci, harmonic patterns, and how we use that volume tool that I introduced a few videos ago in a real life trading scenario. So I hope you enjoy, and if you know you will, hit that like button. This is important for you guys that are new. It's, when you're trading, you want to have defined time frames. So you want to define what are your time frames, right? So for example, as a swing trader, I have 3 time frames that I follow. I have the daily, I have the 4-hour, and I have the hourly. And why that's important is because the market moves in fractals, there's always going to be mixed signals. So you can have a bullish trend on a daily, and you can have a bearish trend on, or let's put it this way, you can have a bullish trend on an hourly, but the bullish trend on the hourly is only a pullback within a bigger bearish trend on the 4-hour. You guys follow me? So let's say my hourly chart looks like this. Would we all consider that a bullish trend, right? 3-point move? Yep. So this is what it may look like on the 1-hour chart. However, when I zoom out to a 4-hour, right? I may see this, right? So on a 4-hour, what is my trend here? Is this bullish or bearish? Well, my 4-hour trend is bearish. My hourly trend is bullish, but you can see that this bullish move is only a what within the bigger 4-hour trend? It's only a pullback. So are we bullish or bearish? And then you go up one more time frame to the daily, and guess what happens on the daily? The daily chart, you see this, right? An even bigger bullish trend. And now you're confused, right? You don't know what to do because you see a bullish trend on the hourly. But then you go up a little bit and you see that, oh my gosh, okay, then that's not a bullish trend. It's only a pullback within a bigger bearish trend on the 4-hour. But then you go up again, you're like, oh my gosh, that 4-hour trend was only a smaller pullback in a bigger bullish trend on the daily, which means the hourly, a bullish trend within a bearish trend within a bigger bull, and then your brain explodes, right? So imagine you doing this and then you going down to a 30-minute and a 15-minute and a 5. Like you're gonna melt your brain, right? So it's important that we understand what time frames we use and what we're using those time frames for. So I say that as an example of what we just looked at. If you are someone that trades, let's say daily, 4-hour, hourly, and you've developed your general analysis, your confirmation bias for what the overall market move is. If you go down to the 15-minute chart, should that play any role in your trading? Your time frames are daily, 4-hour, hourly. Yeah. Now, in all reality, you shouldn't even go down to the 15-minute, right? There's no need for you to go down there. If it's not in your trading time frames, why are you wasting time down there? But we know that people like to look around. Maybe you're playing in the sandbox, right? Don't let your opinion shift because of that. It is simply a different opportunity. And there are always going to be different opportunities within different markets. But the market is harsh, man. It's confusing. It is built to make you go crazy. This is why you have to organize ourselves so that we can unconfuse all that confusiveness. So not much has changed on the higher time frames, but let's take a look at the lower time frames and let's see what happened here. So most recently, going off of our kind of our previous analysis, right? We have done this. We've bounced up, we've come down, we've bounced up, we've come down, we've bounced up, right? Whether you're a counter trend trader looking for shorts or a trend continuation trader looking for longs or vice versa, put that all aside and let's just focus on pure market analysis. If price is going to go higher, right? If this is nothing more than a pullback in a bigger bearish move, if price is likely to go higher, where do you think price would go higher to? I'm actually glad you brought this one up. This follows up directly on the conversation we just had about different fractals and brain exploding. But where would you expect it to go to? And this is the cool thing about analysis, right? It doesn't matter whether you're bullish, bearish, trend continuation, counter trend, right? If you just know how to do good analysis, you're just asking yourself the question, where is price likely to go? How you handle that is based off your particular trading style. But as far as like pinpointing where price is likely to go, that's just being a good market technician, a chartist, right? So would you guys say we're probably likely to go somewhere in this area? Minimum there, maximum there? Is that a good bet? Okay. So we see price action pulling back. If we're likely to go up to that level, because that's the next level of structure, again, whether we're expecting price to continue and break structure or collapse from structure, there's opportunity here, right? Price action has broken and closed above a previous level of structure here, which allows us to make the prediction that price is likely to go higher. We're currently pulling back. You can look for an extension up into this zone, right? This is a nice little day trading opportunity. So as a day trader, think of the hourly as being like your higher time frame. So your hourly is your version of the daily, right? So what you want to do here is we want to go down to our lower time frames. Let's do 15. You can do 15.5. We'll look at range bars as well. And you want to ask yourself, okay, what entry reason do I need, or what do I need to occur down here in order to look for that potential bullish move? Do I need a pin bar? Someone mentioned earlier a doji or something like that. Do I need a double bottom? Right? Whatever your reason for entry is, that's what you're waiting for as we pull back. We've already got some hidden diversions forming, which is a positive sign. Like I said, I personally like looking at these on like what's called a range bar chart. That's not my range bar chart. And so what you may look for on a 5 range bar chart, and range bars, if you guys are new, is just a different perspective on the markets. Instead of each candle being time-based, it is based off of a range of movement. So every single candle on this chart is exactly a range of 5 pips. So it gives it a kind of a smoother look at price action. But this is a perfect opportunity. You can go lower if you want to a 3 range or something like that. Look for price action to come back here and then look to buy it up. Now, the magical question is this. We have this level, right? How can I pinpoint where I want to shoot for targets at in this level, right? We have the very extreme of 140.51 to the very low of 140.25. What are some things I can do? If I want to project continuation targets here, I can do an AB equals CD. Yep. Now we don't have the pullback yet. I guess we can kind of, what I would want to see is a turnaround first, but I'd like to do an AB equals CD from this leg. So we don't have the pullback yet, but you can wait for a pullback and do a 1-to-1 measured move. You can do it from this swing as well. This retracement isn't super deep. You can do it from this swing as well and have an AB equals CD up there. Someone mentioned Fibonacci's. Yep, same thing. We have 2 levels we can bring Fibonacci's from. We have the smaller level, which would be ideal on a lower time frame, but we're just going to stick with this time frame for example purposes. So swing low to swing high right there. Ugh. And back down. You can see a 1618 Fibonacci right there. We can go from this recent swing low to swing high here. And back down. And you're going to see a 127 a little bit lower and a 1618. So not really giving us too much confluence there. We've got everything in random places. We've got AB equals CD a little bit higher, 1618 a little bit lower, smaller 1618 a little bit lower, 127, right? There's nothing really giving us confluence here. Let's try the volume. So I'm just gonna use anchor volume. I'm just gonna click this button right here. I'll do the whole thing just because. And let's see what the volume profile looks like. Now remember what we spoke about with the void, right? Let me delete everything and just put volume back on. Let me isolate it, right? So remember what we spoke about with the void, right? Where does volume start to pick up? Right about here, right? That white line is actually, it's called the point of change. Think about that white line as being like the highest point of volume, right? So we have our volume picking up right here. If you look at this as like a congested traffic area, you may not, if you're using volume, you may not want to shoot above that. So this helped us make our decision on where to look for targets at. And again, you can, I erased it to kind of clear the charts up. You can combine that with all the Fibonacci stuff you had on as well, right? You can see my 1618 is right there as well. So you have some confluence. You have a 1618 Fibonacci extension. You have the volume lining up. This just helped us made our decision. So is that a good example of how to use the volume as far as like those, in this case, a target projecting area? And if you're a trader looking for shorts, just vice versa. That's now the level you're starting to look for shorts at. So that's how I like using volume. As you know, I start with structure as kind of like the perimeter. I'll add other things of confluence, but then the volume is like, okay, I'm having a hard time deciding between this level and this level. Is there anything that stands out? And it's right here. So what you can look for, going back to the trade, is a potential trend continuation opportunity. And if you're an aggressive trader, look, higher high, higher close may be coming in about 10 minutes. Look to trade it up to that level of volume. And I don't know if range bars is giving you the same thing. Yep. So first entry could be a higher high, higher close. More conservative entry could be maybe you get a double bottom, something like that. So as a day trader, former day trader, I guess I should say, this would be right up my alley. Nice trend continuation opportunity, risk reward should be pretty decent. Let me just measure that out real quick, finish this thing off, and then I'll get to your questions. ATR is 4. The low is 139.97. So 93 would be a 1 ATR stop. A 2 ATR stop would be 89. So this would be my range of stop loss. It could be minimum, I'll write this in, minimum stop, max stop. I forgot if I wrote minimum one right there. Max stop, right? And again, we could do the tool or use our tool to kind of do the trick that we did before, right? If I want to use my max stop, and I know my max stop is here, I know my target is white line up here, I know I require a 1-to-1. As long as I get an entry below this level, I'm fine. So I should be good to go in this trade. Now, the question is, Akil, how do I decide between the minimum stop and the max stop? I can tell you right now, I would take the max stop on this trade. Who can tell me why? You're giving yourself more risk, but the trade-off is I'm also giving myself more what? Yep, I'm giving myself more safety. So my minimum stop is right at a previous level of structure. Remember what we spoke about earlier? I want to avoid previous levels of structure. Structure is my protective force field, where if they're going to hold, I want to be below them so I can involve myself in the trade or stay involved in the trade. I don't want to be in a situation where I have my stop loss right at structure. Structure holds, it bounces up in my favor, but I lost because I didn't avoid structure. Right? That's like literally having a force field, right? Alien invasion is coming and everyone's yelling, put up the force field, put up the force field, put up the force field. And then like I'm standing on the other side of the force field. Like, does that make any sense? This might be the greatest analogy ever. Like, imagine the aliens are coming and everyone is running and hiding. And I'm developing this magical force field, right? And everyone, all my friends they're in this force field, right? Where are my friends? My friends are all in this force field protected. And I'm standing right outside here. That ain't smart. And then I'm wondering, right? I get destroyed by the aliens, and I guess in my afterlife, as I'm ascending to wherever I ascend to, I'm like, man, how did they get me? How did they get me, right? That is the equivalent of having a stop that doesn't take into account an important level. Now, important could be whatever it means for you. Important for me is structure. It could be even handle number. It could be Fibonacci. It could be different things for different people. But I don't want to put my stop loss right here. So I'm going to use the max stop on this one, which avoids it. And I'm okay taking on that extra risk, trading it for safety, because I can still maintain my risk-reward profile. If I couldn't maintain my risk-reward profile, I'd have to go with the minimum stop and just cross my fingers. Or right below it, I would say. I'm never going to be right at structure. I need to get below it. But I would go up a little bit higher just to kind of make it work. But I can still maintain my risk profile. So, yeah, decent day trading trade here. Of course, as I say it, we're getting further and further away from our higher high, higher close candle. But things get weird in the last, especially the last minutes of an hour. So we'll see what happens here. But let me get this into our pro trade log as well. I'll answer some questions, and then we need to take our first break. Unfortunately, it looks like Canada is not going to give us, or did not give us, the higher high, higher close. So guess what? That trading idea is off the board. Also, however, a really good opportunity to talk about why it's important to wait for the close of the candle, right? So you can see we were looking at this trading opportunity, right? I'll just delete that right here. We were looking at this trading opportunity right here, right? And then what happened? Price started rallying up. Right? We started pushing above the highs. Now, I want you to close your eyes. And I want you to imagine yourself as a trader who was looking for this buying opportunity. You're waiting. You're excited about it. The risk reward looks awesome, right? You're a new trader. You're ready for some action because we all want action, right? What do you think is going through your mind as you see price push higher? What do you think is going through your mind as you see price kind of moving in your projected direction, but you're not necessarily involved in the trade yet? Is anyone feeling a little FOMO? Anyone feeling like they may miss the trade? It may run without them? Yeah, that's a natural feeling. And what is the action that typically comes with this feeling? You enter the trade, right? So you enter the trade right here. Weight off my shoulder. Relief. I'm in. I'm not going to miss it. You go take a little break, hit the bathroom, grab some food, do whatever you do. You come back and you see this. Price has pushed down. You're either in the red or maybe it's smashed through your stop loss and you're out of the trade. Now, because you guys are here of tier 1, we know that you're doing journaling. We know that you're doing post-trade reviews. And as you're doing your post-trade review, what are you noticing? You're grading yourself on, was it a good trade? Meaning, did you follow the rules completely? How's my analysis? Analysis was good. Identified this and that. Target projection was good. Stop loss was good. Entry reason. Wait for higher high, higher close. Uh-oh. Did not wait for higher high and higher close. Any simple mistake like that cost you money. And That is the difference in trading. It honestly is, with successful traders versus struggling traders, right? You do have to be at a certain level of skill and analysis, but like most traders who spend the time learning it do learn that. The thing that separates them is the discipline. Yes, you have rules, but do you have the ability to follow your rules? And this is a perfect example of an unnecessary loss of money. And I see it all the time. If I open up my little message thing on here, I get it all the time. It was an unnecessary loss of money. Because you were supposed to wait for confirmation to take the trade, the thing that tells you your prediction is more likely to happen than not, and you didn't. And on one hand, there's the trader that gave in the FOMO, entered early, and now lost whatever amount. And then the other trader that's sitting back and just being like, well, never got the reason for entry. Let's erase the tools and go somewhere else. And it's those differences repeated time after time after time throughout the duration of a year in your trading career that's going to separate you. So a perfect example of why we have rules, and more importantly, why we follow those rules. If you enjoyed this video, I know you're going to like these videos as well. So pick one, click one, and continue to progress in your trading journey.